Welcome, deep divers, to another really exciting journey into what's reshaping our world, like right now.
It's moving fast.
It really is. And if you've ever felt that the news around crypto, around AI, is just, warp speed, leaving you completely overwhelmed.
More questions than answers.
Exactly. Then you are definitely in the right place. We're here to sort of cut through all that noise today.
Get some clarity.
Yeah, give you a focused, insightful look at these huge shifts happening as we speak. Okay, so let's unpack this big question. Are we seeing a global regulatory crackdown, something that's, maybe stifling innovation in these really powerful but still pretty new industries?
Or is it the opposite?
Or
Yeah.
are certain regions, maybe with some serious strategic foresight, actually opening their arms, creating like fertile ground for a tech future that maybe others are completely missing out on?
It's a fundamental split, isn't it?
It feels like it, and it's a critical dilemma. The implications, they just ripple out everywhere across the whole global economy. So our mission today really is an in-depth exploration. We want to look at these diverging global approaches, crypto and AI. We're going to focus really sharply on that contrast. What we see in the West, the US, the EU, versus these innovation-first frameworks, like in Singapore.
Singapore is a key example, definitely.
We've gone through a ton of articles, research, our own notes, distilled it all down to help you understand what this means for investors, for developers.
For everyone involved, really.
Frankly, yeah, for the future of these absolutely transformative technologies. So whether you're prepping for a meeting or just trying to catch up because this field changes hourly,
It does feel that way sometimes.
or maybe you're just curious, we promise we're going to deliver those crucial nuggets you need to be properly informed. And hey, before we dive right in, just a quick friendly thing, your engagement, it honestly fuels what we do here.
It really helps.
It does. So hitting subscribe, dropping a comment, tapping that notification bell that directly supports us, it boosts visibility, in the algorithms,
Gets the word out.
gets the word out, helps more people find these deep dives, and lets us keep creating this kind of quality crypto and AI content. It enriches everyone's understanding.
Absolutely. It builds a community.
So yeah, thank you for being an active part of this whole learning experience with us.
Okay, so diving in. What's truly fascinating here, I think, is that we're seeing more than just, minor policy differences.
It's deeper than that.
It really is. It feels like a fundamental philosophical split playing out globally. Almost a tale of two very different approaches to the future of tech and finance.
Two paths.
Exactly. On one side, you've got the Western powers. Think US, EU primarily. They seem to be prioritizing caution, control, a more reactive, often quite stringent regulatory stance.
Risk mitigation first.
Precisely. Their focus is heavily weighted towards mitigating those perceived risks to consumers, financial stability, national security. And they're often using established legal and financial frameworks to do it.
Okay, that's one side. What's the other?
Well, on the other side, you have places like Singapore. They're adopting a much more proactive, innovation-first approach.
Okay.
Their strategy isn't just about managing risks. It's centered on actively fostering growth, development, establishing clear, forward-looking frameworks that aim to encourage and integrate tech advancement, not just constrain it.
So less reactive, more proactive.
Exactly. And this dichotomy, this split, it's not just academic talk. It's actively shaping where capital is flowing, where talent is going,
And ultimately,
where the next wave of tech breakthroughs might come from, potentially for decades.
that framing is so important, these two distinct philosophies for a new era. Let's really dig into that first one, the Western stance, the control and caution approach. Because here's where it gets, I think, really interesting. On the surface, the reasons the regulators give, they sound reasonable, right? Necessary even.
Consumer protection,
Yeah.
financial stability.
Yeah, national security. Who argues against those goals? Nobody.
Of course not.
But it's the execution and the perceived impact on innovation, that's where the real debate is. That's where we see this split starting.
Absolutely. And the why behind those concerns, it's often rooted in history, isn't it? Particularly the painful lessons from past financial crises.
Like 2008.
Exactly. Regulators in the US and EU, they remember the dot-com bust, the 2008 crisis. And more recently, you have things like FTX collapsing, stable coins depegging.
Right, those recent crypto blowups.
They look at crypto's volatility, the speed of new assets popping up, the sometimes murky nature of early DeFi and Web3, and they see echoes of past systemic risks.
So they feel they have to act.
Their mandate, from their perspective, is clear. Prevent that from happening again. And robust regulation, often preemptive, is seen as the main tool. It's not necessarily malicious, it's just a deeply ingrained, risk-averse posture. Comes from their history, their responsibilities.
And we've seen this translate into very real actions, especially in the U.S. The SEC, the Securities and Exchange Commission, they've really ramped things up, often called regulation by enforcement.
That's the term you hear a lot.
We've seen major actions against big players, Coinbase, Binance. These aren't small things.
No, these are significant legal battles.
The SEC is accusing them of being unregistered, securities exchanges, brokers, clearing agencies, saying lots of the assets on their platforms are actually unregistered securities.
Which creates massive uncertainty.
Huge. For builders, developers, anyone trying to innovate in the U.S., is the thing you're building today, maybe a new token for your app, suddenly illegal tomorrow?
It feels retroactive sometimes.
It does. Less like clear rules up front, more like a reactive crackdown, and many in the industry argue that just stifles growth.
Precisely. And while the U.S. often takes that more litigious, enforcement-heavy path, the EU went a different route, didn't they? More comprehensive legislation.
Right, MiCA.
MiCA, exactly. The Markets and Crypto Assets Regulation, it's designed to bring clarity and harmonization across all 27 EU member states. A massive undertaking.
What does it cover?
Pretty much everything. Stablecoins, they make distinctions between different types, crypto asset service providers, or CASPs, their operational rules.
Sounds thorough.
It is, on paper, a big step, but the stringency of some parts, like significant capital requirements for these CASPs, really detailed white paper rules, strict operational standards, it raises questions.
Questions
Like, does it protect consumers by setting a high bar? Yes, but does it also create such a huge barrier to entry that it actually stifles the very innovation it's trying to regulate?
The balancing act.
It's a very delicate balance, and many industry voices feel MiCA leans pretty heavily towards caution, maybe at the expense of dynamic growth, especially for the smaller, more agile startups.
That makes sense. And then there's this other trend we see in the West, right? This focus on fitting crypto into traditional finance products.
Yes, absolutely.
Like the Bitcoin and Ethereum ETFs getting approved. Which, okay, on one hand, that's big. It legitimizes crypto for more institutions, gives people regulated ways to invest through familiar structures.
It signals maturation, definitely.
But on the other hand, it's fundamentally about packaging existing well-known cryptos into these very structured TradFi products.
Right. It's not about fostering the new stuff.
Exactly. It's less about enabling, say, groundbreaking DeFi protocols that might challenge the traditional banks or new Web3 infrastructure for digital ownership.
Yeah.
It feels like Western regulators are comfortable with crypto, mainly when it looks and acts like something they already know how to regulate.
That's a very accurate analysis. The core argument here is that, while, yes, consumer protection and financial stability are crucial, this combination of sort of heavy-handed rules, the enforcement-first mindset in the U.S., and this focus on just integrating familiar bits into TradFi, it might just inadvertently slow down adoption, and worse, push the real paradigm-shifting innovations somewhere else entirely.
Like that hypothetical DeFi startup.
Yeah, imagine a small, innovative DeFi lending protocol. In the U.S., they face huge legal uncertainty. Are they an unregistered security? An unregulated bank? Who knows?
And in the EU?
In the EU, they might struggle with MiCA's capital requirements, the big disclosure burdens designed for, massive financial institutions, not a tiny startup.
So if it's too hard, too uncertain, too expensive.
Then the talent, the capital, the groundbreaking ideas, they'll just go elsewhere. They'll migrate to places that offer a more supportive environment.
And that's not just about losing market share.
No, it's about potentially losing leadership in where the next fundamental tech breakthroughs actually happen. It's about who leads the digital economy.
That's a really powerful point about migration talent capital.
Yeah.
And it sets us up perfectly to pivot. While the West is maybe building these regulatory gates, Singapore feels like it's throwing the doors open.
Right.
Fostering these innovation-first frameworks, trying to balance compliance with being welcoming to startups.
It's a fundamentally different philosophy, almost a direct counter-strategy.
Yeah.
It really is. And if you connect it to the bigger picture, Singapore isn't just reacting. They are strategically positioning themselves. They want to be a premier global hub for this converging digital economy, finance, and tech together.
Like Hong Kong or Dubai did for other things in the past.
Exactly like that. They see the future in crypto and AI integrated. Their vision goes beyond just regulating. It's about actively facilitating development, integration, scaling within their economy.
So they need a regulator that thinks that way.
And they have one in the Monetary Authority of Singapore, MAS. They see innovation not just as a risk to manage, but as a critical national asset, a source of competitive advantage. Their approach is like an intentional invitation. Innovators, come here.
And their actions back that up, right? These big initiatives from MAS, like Project Guardian.
Project Guardian is huge. It's this massive industry collaboration focused squarely on asset tokenization in regulated markets.
So putting real-world assets on blockchains.
Essentially, yes, but within a compliant framework. They're not just talking about it. They're doing pilots with major banks, DBS, JP Morgan, Standard Chartered.
Wow. What are they tokenizing?
All sorts of things. Wholesale funding markets, FX, government bonds, even private credit. The goal is to unlock efficiency, boost liquidity, cut costs in capital markets by digitizing assets and using DeFi structures responsibly.
So not shying away from the tech.
Not at all. Carefully, yes, but enthusiastically exploring its potential in a controlled way. Building real-world uses, which builds confidence and attracts more innovation.
Okay, Project Guardian is one. What else?
Well, they're also way ahead on central bank digital currency, CBDC, pilots, while lots of countries are still just debating if they even need one.
Right. Lots of talk, less action elsewhere.
Singapore is actively experimenting, mainly with a wholesale CBDC for interbank settlements, cross-border payments, not digital cash for you and me, but making the underlying plumbing more efficient for institutions.
Oh.
They're exploring how these DLT-based wholesale CBDCs can make large value transactions, international trade finance, much faster, cheaper, more transparent.
So the government is actually trying out the tech itself.
Exactly. They're getting their hands dirty, understanding the practical applications, seeing the benefits, not just regulating from afar based on theory.
And then there's the accelerators, right, for AI and fintech.
Yes, very concerted efforts there, too. Often run with global tech giants, top universities. They provide this whole ecosystem of support.
Like what kind of support?
Regulatory sandboxes, for one. Let startups test things live, but in a controlled space. Grant funding to help with early costs. Mentorship programs connecting entrepreneurs with experienced leaders.
So actively trying to attract and grow talent.
Clearly. They explicitly see that crypto and AI together can unlock totally new possibilities, and they want Singapore to be the place where that happens, from idea to market.
The contrast really couldn't be starker, could it?
It's night and day. You've got the Western gatekeeper approach. Innovation often has to prove itself safe, fit existing boxes, maybe fight legal battles first. And then Singapore's open door policy, actively inviting innovation, providing clear rules, yes, but also the support and infrastructure to help it thrive.
Trying to become a magnet.
A magnet for the future of the digital economy, attracting capital, bright minds, groundbreaking projects. They're betting that by fostering innovation first, they can adjust the rules as needed later, rather than strangling potential up front.
Calculated risk.
But one they see as essential for their future economic competitiveness.
Which brings us right to the core. Why does this divergence matter so much? What does it mean for you, listening an investor, founder, developer?
Yeah, the practical implications.
So what does it all mean? Practically. Well, it means people are likely going to vote with their feet. And maybe more importantly, with their capital.
Absolutely. When you have such different regulatory environments, capital, talent, innovation, they naturally drift towards the places offering the best, most certain conditions for growth.
It's just logical.
It is. And there's a term for it. Jurisdictional arbitrage. Companies, individuals, strategically looking for the most favorable regulatory environment.
Seeking the path of least resistance.
And greatest opportunity. If Region A has hurdles, legal uncertainty, high costs, backward-looking rules, while Region B offers clarity, support, and open innovation policy, the choice is pretty clear for many.
Can we see this happening already?
We can. Look at metrics like crypto venture capital funding by region. The U.S. was dominant historically, right? But look at trends from, say, 2023, maybe projecting into 2025. You start seeing a real shift towards Asia.
So actual money moving.
Real money. U.S. crypto VC might dip X%, while Asian markets, especially Southeast Asia, might hold steady or even grow Y%. It shows investment dollars are following that path.
And it's not just money, it's people too, right? The brain drain idea.
Exactly. Human capital is just as crucial. We could definitely see a talent brain drain from places with tougher environments.
Smart contract developers, AI researchers.
Token economists, Web3 entrepreneurs. If they feel stifled or even threatened by the regulatory climate in the US or EU, where do they go?
To places like Singapore, Dubai, Hong Kong.
Right, where there's more freedom to build, experiment, innovate without that constant fear of lawsuits or sudden policy changes. The best minds want to create. If one place makes it hard or risky, they'll go somewhere else.
Taking their skills and future economic value with them.
And it's not just hypothetical. It's already happening in certain sectors. You can track it.
Okay, so this raises a big question for investors, for traders. Are we looking at fragmented global markets? Different rules everywhere.
That's a really important question. On one side, the opportunities in Singapore and similar hubs look significant. Projects launched there might roll out faster.
Because the rules are clearer, more supportive.
Yeah, often clearer guidelines for tokens, for DeFi. This could mean friendlier liquidity conditions too, as capital feels more comfortable flowing into these regulated but innovative ecosystems.
So, potentially more dynamic growth over there.
Could be. A surge in genuinely new projects, maybe more focused on that decentralized Web3 ethos, AI-powered stuff. Exciting investment prospects if you look beyond just the West.
Okay, so for you, the listener, what are the actual opportunities and risks? If Singapore is fostering this, maybe the next big thing comes from there, like AI-governed DAOs or new tokenized assets.
That's the potential upside. Higher growth potential, possibly, but maybe different risk profiles too, because the regulatory frameworks are newer.
Right, there's always a flip side. What are the risks of this fragmentation?
Well, while the West might eventually offer clarity, like when MiCA is fully live, that clarity might come at the cost of slower innovation, a more conservative approach.
Okay.
Singapore's speed, while exciting, might initially have less established safeguards compared to the West's decades-old financial systems. It's a trade-off.
So what does that mean for investors?
It means you have to evaluate projects based not just on tech and team, but crucially on their jurisdiction, their regulatory backing. How does fragmentation affect market stability, investor confidence, when rules differ so much?
It gets complicated.
It does. Assets might behave differently or even be unavailable depending on where you are. For traders, it means you must watch for new listings, token launches, DeFi products coming out of Asian markets. That could be where the next wave of big opportunities is, stuff not happening as fast in the West.
This leads us to that really thrilling intersection.
Yeah.
Crypto and AI converging.
Yeah, this is where things get really interesting.
Because these foundational technologies, AI and blockchain, they seem perfectly positioned to create totally unique hybrid startups. Entirely new ways of doing things.
It's not just incremental improvements. It feels like fundamental shifts are possible in how we manage data, assets, even how decisions get made.
Give us some examples. What could this look like?
Okay, imagine DeFi plus AI trading. Not just old school algos, but AI optimizing DeFi strategies across multiple pools, managing yield farming, finding arbitrage opportunities, with incredible speed and accuracy, all transparently on-chain.
Wow. Okay, what else?
Or think about AI risk analysis built into smart contracts, continuously monitoring for bugs, spotting weird behavior, maybe even stopping exploits in real time using machine learning.
That would be huge for security and trust.
A potential game changer. Moving beyond static code checks to dynamic AI-powered security.
And you mentioned AI agents on chain. That sounds wild.
It is mind-bending. Autonomous AI entities operating right on the blockchain, doing tasks, making decisions, interacting with other contracts, even owning assets.
So truly autonomous organizations.
DAOs powered not just by human votes, but by advanced AI managing treasuries, executing decisions based on rules, maybe even proposing actions based on market data.
And this isn't just sci-fi.
It's active R&D. And the regulatory environment will absolutely dictate where these complex convergent technologies really take root and flourish. The place that welcomes them will likely reap the biggest rewards.
So this isn't just a tech race. It's geopolitical.
Fundamentally, it's a geopolitical competition for dominance in the digital economy. The big question is, will the U.S. keep its historical tech lead? Maybe by using its TradFi rails, the ETFs, to bring regulated, maybe more centralized digital assets to the mainstream. Or will Asia, led by hubs like Singapore, Dubai, Hong Kong, take the lead in the truly groundbreaking stuff? The tech that redefines data, finance, ownership, maybe fosters a more decentralized AI-driven future.
How can we track this? What are the signs?
We can watch key indicators. Compare AI investment flows. Is Asia's share rising against the U.S.'s traditional dominance? And look at exchange dominance. Are Asia-based exchanges gaining significant trading volume, getting the hot new listings, compared to U.S.-EU ones now that regulation is hitting?
Those are the metrics to watch.
Those will tell us who's really winning the race for the digital future.
It's clear Singapore is setting a powerful example, but you mentioned they aren't alone in this innovation-first idea. Let's broaden out who else is making these strategic moves, positioning themselves as future hubs.
Yeah, definitely not just Singapore. Dubai and Hong Kong jump out immediately as major contenders.
Right, you mentioned them earlier.
They're adopting very similar playbooks, often drawing direct parallels with Singapore's strategy, comprehensive but supportive regulation.
What's Dubai doing specifically?
Dubai set up VARA, the Virtual Assets Regulatory Authority. They're building a specific regulatory framework just for virtual assets, offering clear licenses for different activities, advisory, asset management, exchanges, trying to create a robust but straightforward environment.
And Hong Kong. They seemed cautious before.
They did, but they've made a significant pivot recently, trying to reestablish themselves as a crypto hub, new licenses for virtual asset providers, and crucially, they're actively exploring retail access to crypto trading, which is a big change.
So real competition heating up in that region.
Absolutely. Both are competing hard with Singapore for talent and capital, offering competitive taxes, special economic zones for digital businesses. It shows a clear regional trend towards embracing this tech, not fighting it.
Okay, those are major hubs. What about somewhere totally different, like El Salvador?
Salvador, that's probably the boldest example, right? A smaller nation going all in on a crypto-first strategy while the big players hesitate.
Making Bitcoin legal tender.
First country in the world to do it back in 2021. Now it's controversial, faces its own challenges, adoption hurdles, infrastructure for things like the Lightning Network.
Sure.
But it represents a fundamentally different approach, embracing decentralization at a national level in a way few others have even considered.
Why did they do it?
Aims like boosting financial inclusion, attracting investment, cutting remittance costs for citizens sending money home. It just highlights the amazing variety of approaches globally. From cautious integration in the West to strategic nurturing in hubs like Singapore and Dubai to outright national adoption like El Salvador, so many different visions for crypto's role.
So when you connect all these dots, Singapore's careful strategy, Dubai and Hong Kong's aggressive moves, El Salvador's bold leap, what's the overall picture?
The picture is a powerful, growing trend. Nations are seriously vying for leadership in the digital economy.
They see it as foundational.
Exactly. They recognize crypto and AI aren't just niche tech or fads. They are pillars for future economic growth, national competitiveness, even geopolitical influence.
It's the ones setting up clear, supportive, forward-looking rules.
They're actively competing to attract the companies, the capital, the talent that will build the next generation of the internet and global finance. It's a strategic race, the gun has fired, and everyone's using a different playbook to try and win.
A global race that really brings us to looking ahead. The long-term future of crypto and AI governance. What does this divergence mean for the world down the road?
Well, if we connect this to the really big picture, the potential long-term consequences are huge. We could genuinely be heading towards a future with very distinct regional ecosystems for crypto and AI.
Like different digital worlds?
Sort of, each with its own flavor, strengths, weaknesses. Imagine a Western crypto world tightly linked with TradFi, maybe more centralized around regulated players, focused on institutions, tokenized real assets, compliance-heavy DeFi.
Okay, and the Eastern version?
Maybe led by Singapore, Dubai, Hong Kong, more agile, innovation first, focused on experimental DeFi, new token models, gaming, cutting-edge AI, and Web3.
And these ecosystems might not talk to each other easily.
They might evolve along different tech standards, different interoperability protocols, even develop different ethical guidelines for AI. It could lead to a fragmented global digital landscape.
A splinternet or split chain.
Those are the terms people use. And think back to that regulatory timeline we mentioned, SEC lawsuits ongoing, MiCA rolling out, while Singapore pushes ahead with Project Guardian CBDC pilots.
The gap seems to be widening.
The pace of divergence is increasing. It's solidifying these different paths, which could make convergence much harder later on.
This really brings it all back home, back to you, our listener. Understanding these dynamics isn't just interesting, it feels crucial now for navigating what comes next.
Whether you're investing, building, or just trying to understand the world.
Exactly. So let me throw out some of those big questions that have been floating around our conversation. Questions that hopefully you now have a richer way to think about. Like, do you really think tight regulation kills innovation? Or does it actually protect investors long term, maybe leading to slower but more sustainable growth?
A fundamental question.
And will Singapore truly become the global hub for crypto and AI? Or can the U.S., with its huge capital markets, its talent pool, somehow catch up or reassert dominance in its own way?
Can they pivot?
Yeah. And if you were launching a token, an AI startup, right now, considering everything rules, capital, talent, would you pick New York, London, or Singapore?
Where would you place your bet?
And maybe the most exciting one for many. Does this divergence mean the next 100x altcoin, the next truly groundbreaking AI app, is probably going to come out of Asia?
It shifts the probabilities, maybe.
Maybe. Your insights on these questions, they're sharper now, more informed, more relevant than ever. Wow, okay. What a deep dive that was. We've really unpacked that stark contrast, Western regulation versus Eastern innovation.
Looked at the ripple effects.
Yeah, the implications for capital, for talent, and peered into this intense global competition for dominance in crypto and AI.
Understanding these diverging paths is key.
It feels absolutely foundational if you want to grasp the future of tech and finance.
And this raises one last important question, maybe, to leave you thinking about. Building on this divergence idea.
Okay, what's that?
If these two paths, these different approaches to governing crypto and AI, continue without really converging, what's the long-term impact on global tech standards? On interoperability? Could we genuinely end up with that splinternet or split chain? Different digital realms, different protocols, different data standards, all based on geopolitics and regulatory philosophy.
Knock-on effects of that.
For global trade, data sharing, the very fabric of our connected digital world. They're profound. Definitely something worth mulling over.
Absolutely. A truly provocative thought to end on. Thank you so much for taking this journey with us today.
Thanks for listening.
Your curiosity, your engagement, that's what makes this whole thing work. Keep exploring, keep asking questions, and keep a close eye on these massive shifts. Until next time, stay informed.